Okay. Technical difficulties there. Sorry about that. Okay. Why are we here today? How many people, let me ask it this way. Does anybody not know what exit strategies are? It's okay to say you don't. Does anybody not know what an exit strategy is? Is anybody using exit strategies or using them like they should be? Man, nobody wants to talk. Come on, Sahu, you can tell me.
Well, I'm still working on getting that first deal rolling in. But yeah, I'm familiar with exit strategies.
Okay. Well, let's see if we can. Trying to get my.
Okay, Tim. So exit strategies, even in the note business, I mean, that's one of the very first things I think about is because I don't want to hold the real estate,
Yep.
but I might end up if I have to foreclose. So you have to have multiple exit strategies or possibilities, and what would you do with them? So it's just yeah.
And it applies to all types of investments, right? Whether it's note buying, single family, land, commercial, multifamily, it applies to everything, right?
Correct.
You want to have an exit, you want to have a way out, just like this little guy coming out of the maze here, you want to find your way out. You got to have an alternate path if your primary doesn't go as planned.
And every deal is different, just because the last two or three worked out three different ways doesn't mean that next one is. So don't think that just because, we were able to sell this in 2 weeks doesn't mean it's going to happen again. So be prepared. And if you're prepared, it's no big deal.
That's right. And remember, those exit strategies are other options that you're okay with, right? You're going to create that strategy. You're going to use that in case the first one doesn't work out the way you planned, or maybe the seller didn't like your plan and disagrees to the offer price or whatever. Then you have an alternate. You might call it, and I kind of look at exit strategies somewhat very similar to multiple offers. You agree?
Yes, they're like you have it's your solution that you can provide your prospect. So the more exit strategy you have, the more deals, different ways you can provide a solution for whatever that situation is.
Yep. And it's, to take that a little bit further, it's not just for the seller, and it can help you with the seller, but also once you've purchased it, then what? You want to have different ways, different exits once you've purchased. So let's say you purchased it and all of a sudden the market crashed. Well, you may not be able to afford to go put $100,000 in the rehab and wait 4 more months. You might need to occupy that home now, just do minimal fix up, occupy the home now, and make it a long-term rental instead. Okay, so it's going to help you with the purchase, with the negotiations, but it's also going to help you with multiple ways of selling it and how you deal with it after you've closed on it. So we're going to talk about that some more here. So we touched on this a little bit already, but you want to have multiple ways out, right? You don't want to get stuck. If you are making offers with only one way of getting out of that deal, then you may find yourself in trouble. Now, wholesalers kind of do that, right? I mean, their one goal is put it under contract at a cheap price and raise the price and sell it. But that doesn't always work either. But if you're doing other things like owner finance and rentals and rehabs, you need to have multiple strategies. And that's what this is all about, is to get you thinking about it so you don't find yourself stuck. If you're not using them, I hope you are after today, but you need to have another way out. You need to use them on every single deal, and they really do tie in with multiple offers, in my opinion. So, exit strategies for your real estate investing business. So, there's contract exits, or outs as some people call it, or contingencies in your contract. They help you terminate the contract or keep, get your contract closed, but a lot of times they're used to terminate that contract if there's something wrong. That's not what we're talking about today. I mean, we're going to talk about it a little bit, but that's not what I'm talking about when I say exit strategies. And I want to just clarify that so that people don't get confused by that. Our main focus is the exit strategies that are going to help you buy it and after you buy the home. What are you going to do with it after you purchase it? So why is having multiple strategies so important? Well, you want to have some flexibility and negotiations and backup offers. If you have some multiple exits, and we're going to talk about this in a minute, so it'll hopefully be clear. If you have some multiple strategies, then you have some additional negotiation capability with your seller to hopefully get that agreement signed, okay? Help you better meet a seller's needs or desires or timelines. There's just a lot of different scenarios, and as Robin kind of touched on it, every single deal is unique. There is no one strategy that's going to work with every single offer you make. You just have to create those live, just like you have to create multiple offers. And those offers have to be connected to a strategy. Okay. Different exit strategies may require a different offer, okay, a different price, and that'll become clear here in a minute. Different sales price, different type of funding, owner finance, short-term, long-term funding, could be IRA funding, but it all, again, uniquely needs to be created for each deal, each seller, each house, each financial situation, each market. They have to be unique for that particular situation. Immediate closing versus deferred closings. Do you have to close today versus 30 days from now? Or a couple months from now? That it's all a part of it. Different strategies can increase your profit margins, i.e. Selling it with owner finance instead of selling it retail. You can make a lot of money selling a house with owner finance. But you have to buy it the right way. You have to set up that note that Robin talked about the right way. But you can make a lot of money when you're selling that way, which is going to increase your profit margins. They can help you control and minimize your risk. What I mean by that, closing next week all cash versus having an option on the house and not closing until you find a buyer. Big difference in risk there. Or putting 5,000 down versus 50,000 down. You know, there's a big difference in risk in that transaction. It could provide additional financing options that might meet your deal or seller's needs better. Bottom line is, it can provide more options for negotiating with your seller. Okay? Again, this isn't just about the seller. Seller's a very big piece of this, because you want to have these strategies in place to negotiate an offer, but it's also about the exits that you're going to use. You know, what are you going to do with it after closing? So just a couple quick contract exit samples here. Not the exit strategies we're going to mainly focus on, but I just want to show you a couple things that, you know, people consider the contract exits or the outs in a contract. You know, an option period, contingencies for inspections, funding approval, clear title, financing. You know, that's all stuff that people put in a contract to protect them and have contingencies in there. Closing, this is a subject to type scenario where they're going to not close until they locate a suitable tenant. Remember what I was telling you earlier about closing today versus when you find a buyer or a renter. You know, they're going to put this in the special stipulations paragraph. Okay? An assignment statement. The contract's fully assignable by the buyer, but no such assignment shall be binding upon seller until the executed copy of it is delivered to the seller. Upon delivery of copy to seller, the assigner shall be relieved of all liabilities under this contract. Most people aren't going to do this, but this is the type of thing that would go in your contract, and not really as one of your exit strategies. Okay, this is more of an option type thing that goes in paragraph 11, special stipulations paragraph. Any questions on those? Do you understand the difference? You see the difference of what I'm talking about? Okay, so profit margins. Different exit strategies are going to generate different profit margins. Like I said, you know, if your intent is to, if you go into a deal where you plan to do minimal cosmetic and then rent it, so a lot of people will buy that at less of a discount. So instead of looking at 70% minus repairs and offering something lower than Mayo, they might do 80 or 85%. Okay, and then go in and just do minor cosmetics and rent it. But what happens if they miss something, or what happens if it turns out it's in a bad area and they can't rent it? They've got to have another exit strategy. So the profit margin on buying that as a long-term rental versus the profit margin on going in and doing a complete rehab, you know, is going to have a totally different profit margin. If you turn around and sell that with owner financing, that's going to have a totally different profit margin. But you have to go through the exit strategies to make sure that they're a viable strategy, you know, in case you need to use it. Does that make sense? What if if you bought it wrong, paid too much, and you can't afford it, the house can't afford for you to go in and put in all the repairs that are necessary. Well, that exit strategy may not work, right? If you bought it wrong and can't afford to do the repairs, or you don't have the money lined up to do those repairs, you're going to have a problem. So that wouldn't be a good, viable exit strategy for you. Okay? Make sense?
Yeah, that's probably one of the more important parts of the exit strategies that helps you to buy it right. Because once you buy it wrong, then you're off from the start.
You are limited if you buy it wrong.
Yeah.
Hopefully you're not in total trouble and big trouble, but you're going to be limited if you buy it wrong. Okay. Control, I guess, by the way, this presentation is fresh, so if you see mistakes in it, then please forgive me. And this is one of them. It doesn't read right. It's really to minimize or control the risk to you in a deal. Okay? Those strategies are there to help you minimize your risk and not only maximize your profit margins, but to minimize the risk in a deal. So I've said it a couple of times already, but what I'm referring to there is, if you're using an option period and not closing until after you find a buyer or a renter, that really minimizes your risk, right? You're not committing to the deal until you find that buyer. If that's an over leveraged type of deal, if you have an over leveraged house, let's say somebody just bought this house 6 months ago. Depending on where it's at, it might have some equity, but probably not enough for you when we talk about the typical discount that we want in a deal, right? So if they just bought this house and now all of a sudden they're getting divorced, or one of the family members passes away or something, and now they can't afford the house, they're over leveraged. Do you want to go in and close on a house that's over leveraged? Do you want to and commit to taking over that payment today? You can't pay cash for the house, right? In most cases. You aren't, because you'll be paying full retail for the house, right? Come on now, people, you got to help me out here.
Yeah, a lot of it is just what the market's doing. If you feel like, I like what you're saying on there. Absolutely, if you're going to do it, put it on the option period, because you're like you said, you're minimizing your risk. You're not fully committed unless you do find your end buyer, yep. And then you can execute your option.
So even though this would be an exit strategy here, it's going to translate into the contract, right? You're going to have an option period that's going to be long enough to allow you to have time to find that buyer or renter before you close on that deal. It's kind of like wholesaling, right? In a way. What's a wholesaler do? They put a house under contract, forget about the profit margins, but they put the house under contract and they're not closing until they find a buyer, right? In most cases. A lot of these guys won't close on it. There are some that will. But a lot of these guys that don't have the money to do it, they're going to put it under contract and they're going to go find a buyer and they'll close on it when they find a buyer. And you can do that same thing with an over leveraged house. If you're buying it, if you're not closing until closing day, the exit strategy is you're going to sell it with owner financing. You're going to get a down payment from that buyer and you're going to close on it. The buyer's going to pay the closing fees, all the closing costs, and then you're going to collect a down payment and you're going to receive a monthly income, monthly cash flow from the interest rate. Okay? So the exit strategy here would be to minimize your risk by deferring the closing until you find a buyer or renter, because the house is over leveraged. Okay, that's just one example. Some strategies are riskier than others. So if you had, naturally, if you were taking a big risk on doing a total rehab in a very high crime area, and you're really paying too much, and you're pushing the high limits of the ARV after it's repaired, that's going to be a little riskier exit strategy. So you have to, that's a strategy you probably don't want to use. Could it be a strategy? Maybe. And what I hope to do in the future is have some scenarios written out that we can actually go through as an exercise and have you do them all. If there's interest in this, we could put together a workshop maybe even on this, so we actually had real deals to go through and work it out and see what everybody comes up with for exit strategies. So keep that in mind. If you're interested, maybe we can go do that and really get into some details to see more about how this might work. But does this make sense about minimizing your risk?
Absolutely.
Closing immediately versus delayed closing after you find buyers and renters, that automatically minimizes your risk versus closing on it today. So I've always been a big believer with this business is all about risk versus reward. The more risk there is in a deal, the higher payday you're looking for. The lower the risk in the deal, the lower profit margins I'm willing to accept. Now, some people are greedy, but I'm a big believer in that. If I can minimize my risk by working off an option versus a solid closing date, then there's a big difference in risk there to me. Financing options and requirements. A lot of these types of strategies are going to be based around what the seller wants to do and what you have available. Do you have your own cash? Do you need owner financing with the seller? Do you have cash to purchase with and sell it on owner finance? Do you need to use hard money? Hard money automatically raises the risk level. So you've got to have some really good exit strategies if you're using hard money to purchase that property. Private money, conventional financing. There's a lot of conventional financing programs. Ruth Ann's got a bunch of different investor type programs. And, these are all types of things that you need to research and know what you have available to you and how they work in order to use them in your strategy. And then there's IRA money. I know when I go buy something with my IRA, I know, automatically that I will pay more a little bit. I will pay more for a house using IRA funds just because I know I have no debt. I have no mortgage, no interest rate, no private money, no hard money fees to be paying. It's my money, right? It's the same as cash, better than cash because it's tax free. So, but you've got to, these are all things that you want to get in place in order to maximize the effectiveness and use in your exit strategies. Okay, these can all have a big impact on how you write your offer to the seller. I made an offer yesterday that I'm pretty sure I'm going to get accepted down in Burleson for a complete rehab. And as I always do, I wrote 3 offers. First one was cash. Second and third were both owner finance, but second one was with a little bit down, and the third one was with nothing down. And of course, when you do nothing down, you offer more money, and you have a lot longer term in your agreement. And I'm pretty sure they're gonna take it. They got to present it to dad, because the daughters are trying to sell it for dad because he don't want anything to do with it. He's 80 years old, been out running around with his girlfriend and don't care about the house. So the daughters just want to get done with the house. Dad wants nothing to do with it. And they told me that the offer was right in the ballpark of what they expected, because they know the house is bad. They told me it was $70,000 rehab, and I said, well, might have been 2 years ago, but right now I think it's about 110. So, but I had, backup strategies there. I had two owner finance strategies, and I would, if they would have accepted the owner finance strategies, I could have easily done a buy and hold and rented that house, or did some fix up on it instead of a total rehab, and then owner finance it. I could have made a lot of money off of those other strategies if they accept them, but I'm pretty sure they're going after the cash offer. Okay. Any questions about this one?
So are you still using conventional financing, Tim?
I'm not.
Okay, that's what I thought.
Yeah, this is just options you do have. I don't use conventional financing to buy.
Tim, could you give us an example of the penalties on hard money if you're not able to pay it off at the 6-month mark? Isn't that kind of the magic time period?
I wish that Ryan was on here, Ruth Ann, because I don't know what how they manage that, but most of those hard money lenders don't like to extend. I'm not sure what Longhorn does. I think they will do an extension, but it's going to be short period and you're going to pay for it. I don't know what it is. I've heard a lot of stories about people losing houses, investors losing houses, because the hard money lender foreclosed because the buyer, the investor, couldn't perform per the note. So, and that's not their goal. I mean, just like Robin said, it's not her goal to take a house. They want to work it out. The banks, they don't want to take your house. They want to work it out. They want the buyers to be successful. When I sell something with owner finance, I don't want to take the house back. A lot of investors are happy to do that. But my goal is to make it work for them and see them be successful with it. So, but I can't answer your question, Ruth Ann. I don't know what it is. Having different strategies makes it easier to negotiate and meet the seller's needs or desires, right? It's not always a need, but it could be a desire. So it's important to think through these different things. And, my best suggestion to you is just start writing them down. Think through them in your mind, write them down. Don't try and just work off memory. Write them all down. We're going to look at a couple samples here in a second that may help you. But, write the stuff down and think about it and fine tune it.
Hey, Tim.
Sir.
I had a quick question for you. I threw it in a chat. No, you're not a lawyer. You can't give legal advice. But I had a question about when you're using that language in paragraph 11 to give yourself an out, if you will. Do you leave that closing date blank in those cases?
No.
Are you executing that contract, or do you still put a closing date on it?
I put the closing date in. Now,
Okay.
I mean, well, it depends on the deal. I mean, if the seller knows we may put TBD in there.
Gotcha.
But the seller is going to have to be in agreement with it, or put it in there and know that you can also put language in there. Buyer reserves the right to extend the closing date 3 times or 2
Gotcha.
times, 30 days each, or something to that effect.
Okay. Thank you.
So that's a really good question, though. From a legal perspective, you want to be. Some people like to be as vague as possible. I think you want to be as specific as you can, and keep yourself safe with it. If you leave things too open, somebody's going to find a hole there. So, long-term hold is another exit strategy that you should be considering. Is the house something that you want to hold? I mean, could you hold it? If you're buying with hard money, is a long-term hold strategy a good strategy? Probably not, right? And if you're buying it with hard money, unless you're going to do something with it, rehab it, or if you know that the numbers are really good, you're buying it 30%, 30 cents on the dollar, then you could then go take that and go to Ruth Ann and probably refinance. Now, you'd want to talk to Ruth Ann about that in advance to know what the criteria is to do a refinance on that property. Is the house going to pass inspection? Are you going to go do any repairs to bring it to code, things like that, in order to qualify for a refi? You got any comments on that, Ruth Ann?
Well, remember the strategy we talked about the other day, the delayed financing. If they're paying cash for it, then I can refinance it as long as it is within the first 6 months, and I can use today's value, not the price you paid, not the acquisition cost. But if you wait past the 6 months, then it has to be, after 6 months for you to be able to get any cash out. So it depends on if you're just doing a straight rate and term refinance or whether you're doing a cash out. But I'd be glad to give anybody any details if they want to send me an email.
Yeah. So
you're saying, Ruth, you're saying that if you want to do a cash out refi, that you have to hold the property for at least 6 months?
Right.
Okay.
Unless you didn't have a note in the beginning. If you use hard money, then you have to wait after the 6 months to use today's value and to get a cash out. So that's the reason I was asking about hard money, what the penalty is. We had one party who wanted to refinance and get cash out based on today's value, pay off the hard money before 6 months. Couldn't do that because he had the hard money lien. If he paid cash out of
cash, if you pay cash, then you can refinance them before 6 months.
And get your cash out that you put in the beginning, but not somebody else's cash out.
Right. Yeah, you have to pay with your cash.
Right. And Ruth Ann, what are you? What's the value? Is it 75, up to 75, or 85% of the value cash out?
75.
75. Okay.
Now, that 75%, just to be clear. So let's say the house is worth $100,000 and he paid $50,000. Is he getting 75% of the 100 or 75% of the 50?
Depends on what he proves. If he spent $25,000 repairing it or whatever, he can get up to the amount that he spent as long as it does not exceed 75% of the value today.
Of the value.
But if
Okay.
you don't want to have to show that you spent another 25,000, you can't get the 75 in this scenario. You would get whatever you prove that you invested in it. And it can include closing costs and repairs.
So if he did hard money just to close it quick and not lose the deal, he paid 50,000 plus closing costs. He could turn right around and come to you and refinance and get his money back.
No. He would have to go by acquisition cost. You only get today's value times 75% if you paid cash. That's within 6 months. Otherwise, you have to wait 6 months and 1 day, and then you can do it. But you've already incurred your cost for your hard money penalty if you wait 6 months and 1 day and used hard money. So did I make that clear? If you take your own cash or 401k, whatever, there's no lien on the house. They'll see a hard money lien. If you try to hide it, they'll see it. Even though it's not recorded, they'll see it.
But what if I paid my cash? No hard money.
If you paid your cash and bought it for 50,000, spent 26,000 fixing it up, and it's now worth 100,000, then you can get 75,000, not 76,000. You can get 75% of the today's value as long as it's not more than what you spent.
Okay.
I see. I got it.
So, having said that, same house, same scenario, except I didn't do any repair. I just spent the 50,000 plus closing costs and bought the house, haven't done any repairs.
Within 6 months, you can get back your 50 plus closing costs.
That's where I was going. Okay.
Yeah.
I was just thinking about if somebody just wanted to close on it quick to not lose the deal.
Mm.
You know, because there's a lot of deals out there, cash only, right? No financing, cash only. So you go pay cash and then come back to you and refinance and get your money right back.
Every penny.
Okay. Okay. And today's limit on loans in your personal credit is 10. Is that correct?
Actually, because of our sister bank, we have more access. It's unlimited as long as whichever investor I put you with doesn't have more than 7 of their own loans for you. So you could have 15, 20, 25 loans as long as 8 of them, you didn't try to get the 8th one from one of my sources. They only want 7 of them on their books, maximum.
7 on your books.
Yeah, on wherever I go. So if I go to my sister bank, they'll take 7.
Okay.
If I go to, so.
And how many sisters do you have?
Just the one. Just the one sister bank.
Okay. I had to ask.
Well, we have opened up now that things, they were loosening up a little, and then I know they're going to get tough maybe again. There are a few non-QM lenders who are closing. Sprout closed, and FGMC closed. Those are companies that made loans that didn't fit the tight criteria of normal mortgage bankers. But we do have brokers that we can go to who will do other programs that I haven't mentioned. And so I have access to those people and their lines also. So right now we have one sister bank that we can broker.
Okay.
So I doubt I haven't had anybody yet that I've had trouble getting it situated.
But anyhow, back to the chart here, financing has a big play in your exit strategies. And the more financing options you have, the more strategies you might have for a house. So keep that in mind. You might make a house short-term rental, an Airbnb type thing. you know, it's not something that I do, but I know there's a lot of people doing it today. I did just see an article where some places changing all their rules and laws on Airbnb. I don't know if anybody saw it, but they're making it permanent. This particular city, I can't remember where it's at now. This particular city is banning all parties from Airbnb units. You cannot rent a house if you're having a party. So rules are changing, and you know, those are all things that you need to know about, understand as part of your exit strategies. So making cash offers on deeply discounted, deeply discounted below Mayo. Mayo is ARV times 70% minus repairs, right? And we never offer Mayo, right? You're always going to offer something less. And, one year, and by the way, this is an example of a deal that you might consider. So if you're making that cash offer, but the seller doesn't like it, one of your backups might be that, the buyer won't accept that deep discount. So offer a higher, my chart's in the way, offer a higher price and perform minimal cosmetic updates only and rent it. That could be a viable exit strategy, couldn't it? If they won't take the deep discount, then one of your strategies might be raise your price, but that raising the price may not allow you to do a full rehab. And a lot of times, if it just takes just a little bit of lipstick to make it good for rental, you can get out of it a lot easier that way, and still satisfy the seller in their price. Does that make sense? Is that a good exit strategy?
Yeah.
Yep.
Another exit strategy might be buyer won't accept that deep discount, offer a higher price, perform the cosmetic updates, or no updates at all, and sell it with owner finance or a work for equity program. For those of you that may not know how owner finance works, there's a lot of buyers out there that love to do their own work. They want to do their own work to make it their own, do it the way they want it. So an owner finance or a work for equity type of program is right up their alley. And the fact that you can raise the price of the home because you're offering it with terms, you could take that $100,000 home and raise it to $115,000 to $120,000 and offer it with terms, and somebody go in and fix that house up. Now it depends on what's wrong with it, of course. It can't be falling down and do that, but if it's just cosmetic type things, you'll still be able to sell that house quite easily. There's a lot of factors involved, but this is an excellent exit strategy to use if the numbers are tight, because you can always raise the value of that home by offering terms. Now, you have to be able to buy it the right way in order to do that, right? You're not going to be able to go buy it with hard money and then turn around and sell it on a wrap mortgage. It's not going to work. So you have to either have conventional financing or your own cash or an IRA lender that likes long-term funding, things like that. You've got to have the right purchase financing in order to use that exit strategy. What other ideas might you have? What other exit strategy would you propose for this scenario of making a deeply discounted Mayo offer and the seller not liking it? What other exit strategy might you think of?
So you could actually buy it with owner financing, either negotiate. So I like, how you're doing it, Tim. I do it a similar way, is where, I do the 3-tier offer.
Mm-hmm.
So the first one is the discount at the lowest price, but it's cash. And then, the second, third is just a higher price, but with terms.
Yep.
And generally you're buying it with either subject to or just straight owner financing.
Yep. And what if it's worth 100,000 and they want 100,000? So that's different than this Mayo offer here, right? 70% minus repairs. What if it's worth 100 today and they want 100 because everybody in the neighborhood's getting 120 or 130? What kind of a strategy would you use? What kind of a counter offer might you make them?
You could do an option like what you were talking about earlier. Put it, so control it with an option. Find your buyer. If you get your buyer, then you can execute the option, and then either owner finance it, or if they're bringing in, they got new financing, then you cash out.
Okay.
But it depends on the area. If the area is moving, then that's a strategy you could use. If there's not much activity, then you may pass on.
So if another way to do that would be, if you want to owner finance that home, what if you offered them 105 or 110 as an owner finance note? Would you ever pay them more than what they're asking? This is kind of an advanced thing now, but seriously, would you ever pay them more than what they're asking?
Yeah, you could be willing to pay them more if they're willing to tote that note for you through that I want to finance deal.
And you have the right terms.
Yeah.
Yep. So in order to make these kind of deals work, you have to be, if they're focused on profit, if they're focused on that bottom line sales price, and they're stuck on 100 and they get excited when you offer them 105 or 110, what you need in order to make that kind of a deal work is either very low interest rate, or either very little down or nothing down for some period of time that would allow you to get it occupied, start cash flowing it, and recoup some of that money that you're paying the seller extra on that house. Does that make sense?
Your idea I love always, when I hear it, I just almost shake my head, is no payments to them for the first year, or no payments to them for the first 2 years.
So I think you're referring to the deal I've talked about numerous times on these calls, Ruth Ann. Saginaw house a couple years ago, brand new house, year old. Husband and wife, Army veterans, bought the house, paid cash, paid $145,000. Now I wish I had this house still at $145,000. It's probably worth about $350,000 today. But they paid $145,000. A year later, the husband passes away. She wants to move back home with family. She's a little disabled, so she has a hard time getting around, keeping the house clean. The house was not a mess. She just thought it was. But she didn't want to deal with realtor listings and having to leave all the time for showings and stuff. She just says, Tim, I need a quick sale, but I don't want to lose money. Can you help? I said, yes, ma'am, I can. And bottom line was I went home and I put together 3 offers for her. Even though she tells me she don't want to lose money, I still go through the process like you said, so, and just I always give them 3 offers. So she didn't like the cash offer. I knew she wouldn't. I think it was 90,000 or something like that. I don't remember the numbers, but so it was low. But then I gave her 2 more offers with owner financing. One was with $5,000 down, and I did that because I thought she might need moving money. She didn't want that. She wanted the maximum price, and my top offer was $1,000 more than she paid for the house. I paid her $146 instead of the $145 that she paid for it, with nothing down and no payments for 2 years.
Nice.
Then the payment started, and it was either 2 or 3% interest rate. And when I presented the offer to her, you know, she quickly told, I don't remember what offer 2 was on sales price, but it was lower than the 146. She said, I don't like those 2 offers. I like number 3. She says, when that payment starts, that's 2 years from now, that's when I turn 65. I'll just consider that part of my retirement income. So she was collecting, I think, $463 a month once those payments started. And I was collecting for the first 2 years. I rented it at $1,400 or $1,500 a month, and I wasn't paying her anything. You see where I'm going there? Is, you know, remember what I said? If you're paying too much for the house, then you got to have some way to recoup the extra money you paid the seller, and that's how you do it. If you're not paying a payment to the seller, but you're collecting an income, that's how you're making up for it. So I was collecting $1,400 to $1,500 a month for 2 years, not paying her anything. Then the payment started at $463, I think, to her. At that time, I sold it on an owner finance wrap mortgage for $165, and I collected $15,000 or $20,000 down. So I felt I did pretty good. And oh, by the way, I'm paying her 2 or 3%. I was getting 8%. So I had a very nice cash flow on that deal. And then I sold it on owner finance. They ended up refinancing just like we planned, and it was paid off. Does that sound like a pretty good exit strategy?
That was awesome. Great terms.
Now, can you do that on every deal? No. But one thing's for sure, the answer is no if you don't ask, right? The answer is no if you don't ask the question. So
what was the term on that, Tim? Did you have to give her a balloon payment in like 5 years, 10 years?
yeah, it was 5 or 6 years.
Oh, okay, gotcha.
But you didn't have any payments for the first 2 years. That's pretty nice.
And you just have to be able to explain why that is. You wanted to not lose money on the house. I gave her the $146 after owning it for a year. It wasn't a huge profit, but she didn't want to lose money on it. And then she saw that income kicking in at the same time she was turning 65, and she liked it. All I really did is give her what she had asked for.
That was like almost $35,000 just in the payments for those 2 years.
Yeah, I never really did the math on it, but I think I did pretty good. So the owner finance strategies, when you learn how to use those in your exit, you can make a lot of money. You can make even more money if you learn how to use them on the purchase side. And one of the ways you can do that is with offering more money. I mean, are we in a competitive market today or what?
Yes.
Seller's market, right? Hot seller's market. And I'm here to tell you that not every seller out there has a mortgage. Not every seller out there needs to have all cash at closing. So that's where the pre-screening of the seller situation and being creative with your offers and your strategies, your exit strategies, and how to translate those strategies into the offer and negotiating with the seller, you can make a lot of money. Not everybody. There's a lot of people paying cash to buy houses, homeowners, and they don't necessarily need to have all cash at closing. And you can.
And Tim, something you just said made me think maybe I should share this. We had a board of realtors meeting, coffee rather, yesterday, and the agents are very excited that even though their sellers have been able to get more than what the house is worth lately, that has started to turn around. Sellers are starting to drop their prices. There aren't multiple offers every time. And I tried to tell them to, instead of having the seller drop the price drastically, they might want to offer a healthy concession to the buyer to help with closing costs to get that deal sold at a higher price, because that helps the buyer more. You know, I see them struggling coming up with their closing costs. So we're starting to see that turn, and we're back to, this week we were back to April's interest rates. So if that helps anybody kind of be aware of what their competitors are seeing, then I wanted to share that.
So the interest rates have come back down again?
Yes.
Oh, nice. What are they at now, roughly?
Well, I could send that over to you, but we have had average on government loans under 5 again, and conventional loans in the 5s. And I'll send that over to you. I emailed it to someone a few minutes ago. So
okay.
So it's looking better. It's liable to get tough again. We're not sure, but you know, we're definitely not through the tough times. But it's not like it was a month or so ago.
Yeah. But you are right. I have I receive email MLS listings from a realtor, and I can see in that list of properties that the ones that are on there aren't showing up one day as new listing and pending the next. I mean, there's a lot of them staying on there for many days before they go under contract. I've also seen numerous properties going back on market for whatever reason. And
another drastic number is, I don't remember the time period they were quoting, but 560 new listings and 580 price drops. Not of the new listings,
right,
but of the previous listings.
580 new price drops.
Right.
That is good news. Did they say how many months inventory?
They probably did. I'll go back and see if I can find that again.
The last number I heard on the months of inventory, we were back up to 4 months. There was a time a few months ago we were under a month's worth of inventory.
Yes.
So that all adds up with the new listings, the price drops. You know, things are going back on the market. They're sitting on the market longer. That's all good signs for us as investors. Now, again, those properties I'm typically not dealing with anyhow because they're listed and I much prefer and have much better success dealing with an off-market property and talking to sellers. And I would encourage you to do the same thing. There's nothing wrong with looking at those listed properties, but you've got to have access to those properties right away if you expect to get in there and make an offer when you see what you think is a deal, and get out there and see it quick. But remember, you're still going, even though you're not seeing as many multiple offers and as many over asking price offers, there's still some competition there. So even though you might jump in there and make a full price offer, you still might not get it. So, but there's nothing wrong with getting with a realtor friend, if you know one, getting them to set up email notifications for you for new listings with some search criteria for you to receive those notices, and start watching the market. And that's what I'm doing. I can see what you just said, Ruth Ann. There's new listings coming in, and they're sitting on the market longer, and those are all opportunities and all good news for us. The other thing I heard, just as a side note, I heard the other day that Texas was third in the nation with new foreclosure listings. And that was music to my ears as well, because those foreclosure listings are potential subject to deals, pre-foreclosures for us as investors. And those are great properties to be able to step in, bring your arrearages current, take ownership, and then owner finance those properties or rent them. So, and that's always a good exit strategy. Okay, any other questions about this? Anybody else have a proposed exit strategy idea? How about a note type strategy, Robin? Maybe she might have left. Okay. What if you had a deal where you wanted to purchase and rehab, but the seller's price is too high? And this kind of is going along with what we've been talking about. Price is too high, but he really wants to sell. Backup strategy might be pay a higher price, do minimal work, and hold as a long-term rental. We kind of talked about that earlier. Yeah, we already kind of was talking about that same thing. Anybody have any other ideas on exit strategies? I think this was the last one I had. Yep.
Tim, have you ever done a novation deal?
A what?
Or a novation deal?
I don't know what that is, Frank.
I've had I had a wholesaler reach out, and they were doing something like that. So it's basically an agreement with the seller that you kind of you pay for the repairs. You put it on the market and together, and you give the seller their costs, and you, I guess, make the profit of what the repairs would have done. Something to that nature. But yeah, I had a couple people ask me. I had a house in Denton, and they mentioned something to doing something like that. So I was just curious if you had done anything like that.
Can you walk me through that again? Was that
so it'll be, for instance, I make an agreement with the seller that I will pay for the repairs to get this house market ready. Once it's market ready, we'll put it on the market together. And then we, I guess, agree to, I guess, a percentage of what the house sells for. Say I, give them their number, and then I get the rest. or, you know, you just have to work out the numbers in that case on what the house is, what, you know, what would it be worth and how much, you know, it'll appraise for. And I guess that the comps make a big difference, you know, on what.
Yeah. So my first response is going to be, that's a huge risk to you unless you do it right. I mean, there's a lot of details that are going to have to go behind that transaction in order for you to be safe. You know, my first comment would be, why would you spend money on a house you don't own?
Right. Well,
So,
I mean,
Hey, Tim. Hey, so we know this is equity partnership is how it's being referred to in our circles.
Yep.
And so essentially you do get the deed before you do the work. So you do own the property through
where I was
subject
going
to.
with that, yeah.
And then you have to make that agreement that they'll get their number so long as obviously it appraises and sells for higher, then you can secure that deal with them and their number that they want or need. And then you get the profit above that. But so to your point, the numbers have to work out as far as the market carrying that valuation once you get it back up to where it should be as far as the renovations, et cetera. But you do have to do subject to on the front end.
Yeah, there's probably a lot of different names for that transaction, all meaning the same thing, and there's probably several different ways to structure that. But yeah, you're going to have to, Frank, to answer your question, you're going to have the right documentation to protect you, and make sure that you are in control of that transaction. And you know, I would probably have a promissory note to the seller for the monies that we've agreed to, you know, so that they knew that they had something to refer back to if you didn't pay them.
right.
You would definitely want to be in control of that transaction if you're going to be spending money on a house.
Absolutely.
That's why, you know, if you ever go get a subject to deal and you know, you just got it on an option period, but it needs some work, it needs some cosmetic help, whether that's cleanup or paint, you do not want to go spend money on that house because you don't own it.
Right.
You know, if you're just in an option period and you know it needs a list of things done, it don't cost much money, you just don't want to spend the money until you own that house.
Right. Right. Gotcha.
You
Appreciate
know,
it.
it's different if I mean, whether you want to go mow the lawn or something, you know, to make it look better from the street, you know, to market it for sale, that'd be up to you. But you know, again, I would not recommend unless you know for certain. But it's a business decision for you whether you want to spend money on that house that you don't own, because you may lose it.
Right.
Tim, how safe is it to go out and file a mechanics lien against the house if you can't get it deeded to you?
File a what claim?
Mechanics lien.
I've never had to do that, Ruth Ann. I know it can be done, but you know, contractors do it all the time.
Yeah, you just go down to the courthouse and just record your lien. It's pretty.
Never had to do it.
Yeah, I've never had to do it either, but that's how I heard it's done.
And you know, that's another thing, Frank, that could be done in that deal too. You know, is you know, if you give them a note or go file a lien against the property, and they see that lien against the property, they know when you sell it, they're going to get their money. Now, just to be clear, I'm not giving you any kind of legal advice and stuff, but you know, that's these creative strategies like this are something you're going to want to talk to your real estate attorney or the title company just to make sure it's clear step by step. I've not done that type of transaction, and but it seems like it makes logical sense as long as you have the protections in place that you know you're going to get paid and you're not going to be left hanging with no money in your pocket.
Right.
I think what I had heard, that if the house doesn't end up selling for some reason, you know, they come up with money and decide not to sell it, then I think you have trouble collecting it. But again, no idea.
No, I mean,
Just hearsay.
that's exactly one of the reasons I say you want to be in control. You want to have that deed on the property. You don't want them to back out. If you go in and spend all that money and make it nice and pretty, now they're happy. Oh, I don't want to leave now. It's nice, you know.
Right.
Or just life situations change without any, you know, intention of defrauding you, but circumstances do change, and you know, they may no longer want or need to sell, and you're left hanging with the bill. So that's why you want that deed, like Jennifer said, you want that deed, and then you can protect the seller with that note and that lien.
And Tim, can you put in a memorandum of contract if you have any suspicions that they might try to go behind you and work with either another investor or even try to list it on the MLS in the future after you've done the work? You could file that MOC so that nobody else could compete for it. I don't know if that's appropriate in that situation or not, but
you can do that on every contract you do.
That's good.
So in 22 years, just full disclosure, in 22 years of doing this, I've only filed that memorandum a couple of times, just because I didn't ever feel I needed to do that. But it is a very safe thing to do to protect yourself, especially if you're talking to people that may be out for their best interest only, and may be talking to multiple people, and you just have a funny feeling that, you know, they don't understand that this is a legal binding contract. They may be out there talking to many other people. But having that memorandum filed on public records is a good, safe thing to do if you get a contract signed on that house. All right, what else? Nothing else?
I had a sub 2 question for you, Tim.
Okay.
It's a little specific situation, but have you ever got a property subject to, and then at a later time, the original seller that you got it from, have you ever put a wrap note in place?
A bunch of
back to that original seller? Not to a new seller? Back to that original seller, not to a new buyer. And I'm asking this because I got a lady, she has actually 2 mortgages, right? She got a second lien, and that second lien and that primary lien are on 2 different schedules. So I got a unique situation where we can take care of the second lien, go ahead and leave the primary note in place, get it subject to. But in the event she decides that she wants to keep it or stay off in it, that's why I asked that question. You know, I could lease it back to her. She already has a primary mortgage in place that I would then have subject to. So I could you turn around and wrap that second note back to her? Or does that make sense?
Well, I'm not real sure what you're saying, but if you've got, I've done a lot of sub 2s. Mm-hmm. I have never given a wrap note to the seller.
Okay.
I've always, you know, taken it subject to, just like the term refers to. Mm-hmm. So I get the deed on it, and then I turn around and sell it or rent it, one of the two.
And that's my question. When you sell or rent, if I'm dealing with the original seller, the options with the original seller could be to rent it back from me, right? If I acquired it subject to,
So, but why would you do that?
because she has a second lien on it that's accelerated.
Okay, but oh, the second is
The
accelerated.
second lien is accelerated.
Oh,
That's right.
I missed that. I didn't hear you say that.
So the primary note, she's in great shape, but that second lien, she don't want to refi. And so that's why I was kind of wondering, have you ever run across that where you got it subject to, took care of the second lien, but that person's in good shape, still want to stay there, you turn around and then rewrap that back to the seller?
So, I personally wouldn't do it, and here's why. And this is I kind of relate this to a pre-foreclosure type scenario. You know, if they were in foreclosure, which she really is, right? She is in foreclosure.
Got a few months before she got to make a decision.
So she's a pre-foreclosure though.
Yeah, we can say that.
Because she's behind on the second mortgage. So I don't know that Texas ever did implement this law, but there was talk many years ago. There was a lot of scams going on where investors were going in and they were talking the sellers out of deeding the house to them, and they would be happy to let them rent it. And then the first thing that ever happened to them, the investor is evicting that now tenant, was owner. They're evicting them, and they were really just after the house. So, and they were kind of misleading them on what they would do, tell them they could rent forever or whatever. But the bottom line is you got to think about the big picture and think ahead here. If they're having financial problems and not being able to pay the bill, what makes you think that they're going to get their act together and pay the bills in the future? Something happened to her to have a second lien and to not be able to pay. And how's it going to look if you end up in a court of law where you took it subject to, she gave you the deed, you took it, you rented it back, and now you're evicting her for something? And it was just it's not that you would do it, but what's the perception? And is it worth that headache if you end up having to go to court, you spend all this money on lawyers and stuff? Is that worth it to you? And, I would either take it subject to, and then she'd have to move, is really the bottom line for me, is take that deal subject to, go find another home for her and try and help her with that. But I would, to make it a clean transaction with no doubt about what you were doing, the fact that you helped her prevent a foreclosure and losing the house altogether by the second lien foreclosing, that's resolved by the fact that you went and paid it off, and you could even have a disclosure signed very clearly stating what it is you're doing and the benefit to her. But I would not put her back in that house.
Back in. Gotcha. Okay.
That's just me. Other people may do it, but I just would not do that.
Gotcha. Thank you.
It's your reputation that you're long term that you're going to be dealing with, and you don't need that kind of headache, I don't think. And you just don't want anything, you don't want her to be misled or misunderstand. Because I'll tell you that in all the years I've been doing this with sub-2 deals, even though I've had very good luck with them, some people don't clearly understand what it is you're doing, when you're doing it, why she's doing it, So you have to be very clear, in my opinion.
Thank you.
What else? So was this helpful? I mean, I put this together really fast to try and address the issue, the exit strategies, I think, feed your multiple offer strategy, but they also help guide you on what you're going to do after closing. What do you plan to do? And if one of those approaches fails for whatever reason, do you have a backup to it? You know, can you do something else with it? You know, is that selling it? Is it selling it on a wraparound mortgage? Is it rehabbing it and retailing it? Is it hoteling it? Is it just go in and cleaning it up and put a little fee on it and reselling it? You know, you got to think through all those things when you're making those offers, and have a clear plan of action once you do go to closing on it.
So on your on these exit strategies, Tim, is it still in Texas the law that you cannot do lease options or contract for deeds when you're buying or selling?
It's not illegal. It's just really difficult to do and stay legal with it. There's a lot of things you have to do. And one of the biggest issues with lease options is and it's been a long time since I read the law because I don't do them, but one of the big showstoppers for me was that the law says you must give them a deed to that house in less than 180 days.
Okay.
And, you know, that's, in order for me to comply with a strict timeline like that, I have to be in control. And I can't control their credit and their income. And, you know, if they haven't gotten their credit cleaned up where I can go, or if they don't have down payment, you know, whether it's a down payment issue or a credit issue, if they don't take care of it and they're not ready before 180 days, you got a little bit of a problem.
Okay. Yeah, I haven't done that. So I think 2005 was when, somewhere around there is when they made the shift. And so I've just done the rentals back then. So I just wanted to make sure that was still the case.
Yep. Rentals and owner finance.
Right.
You know, the owner finance wrap is the alternative to the lease options, in my opinion. Contract for deeds are the same way. I don't remember all the, I've never done a contract for deed. That was before my time, but it is very similar. There's a lot of requirements. It's kind of like stop signs. You know, you're good. You can run that stop sign as long as you don't get caught. Well, you can run your business kind of shady and loosely and not do all the proper documentation and notification and so forth for an owner finance, for a lease option or a contract for deed, and get away with it until you don't, right? If you ever do something that causes that buyer to take you to court and the court finds out that you haven't done all of those documentation requirements that are required by that law, then you're going to have a problem. And again, it's been a long time, but the lease option law, one of those penalties in there for not providing all the documentation necessary to the buyer, once it is identified, it was a $25,000 a day fine until resolved. I don't know about you, but I can't handle it.
Yeah, exactly. Yeah, the contract for deed was the first one that changed in Texas because, like what you're saying, a lot of shady investors were doing the contract for deed, and then they were not actually handing over the deed at the end of the contract. And then the same thing with lease options. You know, similar thing happened there, and so they changed the laws for that.
Yep. And they, you know, they do everything they can to cause the buyer to default and keep the house. So it gives us a bad name. So I don't even, because of the risk and all those little ins and outs and stuff, I don't even want to deal with it. I just stick to what I know and what's easy and safest, and that is, you know, either buy them as a rental property or buy them as and sell them as an owner finance wrap mortgage. Of course, the wraps are a little bit riskier for us, you know, if they decide to file bankruptcy, but there's still a way of dealing with that and just minimizing your risk as much as you can. But the rules are pretty clear compared to the contract for deed and the lease options. Okay, well, today was a little bit shorter. We didn't have near as long of a day today. Is there any other comments, any other ideas on exit strategies? I hope this was helpful. I know it was kind of short, but I hope it was helpful to you.
Yeah, that one on some of the participants are mentioning where you're dealing with the seller. And I agree with you, you know, because you're dealing with seller psychology, especially when you're doing subject to, they're still going to, you know, until you get that loan paid off, you're still going to be dealing, you know, you're still managing them.
Yep.
Actually, you're managing the loan, but you're still connected with them until you get that paid off. But yeah, it just sounds really risky keeping either dealing with the seller still in a deal versus just, you know, make a clean cut, you know, get the deed and then just manage the property moving it forward.
So I just paid off a subject to seller that I bought their house almost 12 years ago.
Mhm.
And, you know, throughout that 12 years, never had a problem with that seller. And I think, you know, I attribute that because, I mean, that's pretty much the norm for my subject to transactions. I don't have problems with the sellers. And I think I attribute that to the fact that they understand the transaction to begin with, and I keep them posted along the way, you know, once, twice a year, checking in with them and letting them know what's going on and where we stand and all that. And I think that just helps to make them understand the deal, make sure that the communications is still working, you know, emails, phone numbers. I text them once in a while to make sure the phone works and email them once in a while. And, you know, you want to ask them questions that require a response to try and make sure that, you know, you are still connected and that kind of stuff. So, you know, and it all works out usually. So don't think you can just sign that contract, get the deed, and you're done with that relationship. They're going to be your family until some point down the road when you pay them off. I just did another one, paid off one from about 3 years ago. What I find interesting there is I've talked to her numerous times over the 3 years. Now that I've paid her off, she don't want to respond. She didn't even say, well, thank you or anything. She just hasn't responded to text, email, or the mail with all the payoff letter from the lender, you know, the release of lien, all that stuff. Hasn't said a word since. But that's okay. We're done. Alrighty.
Thanks.
Anything else? Anybody? James, you've been really quiet today.
Just listening, see what I can pick up.
Is Ruth still on? Ruth?
Yes, I'm still here.
Ruth, you mentioned earlier that, and I wasn't sure if I understood, but when you said some of your lenders that you were, I think it was when Tim made the question about if you had other sisters out there that you were dealing with, but you said that they were dropping off. Are you saying that they're going out of business?
Yes.
Is that what you meant by it? Okay. So you're seeing a lot of that happening?
Well, so far I'm only aware of two. These are non-QM lenders. You remember back in 2008 when they talked about the subprime meltdown?
Oh, yes. Oh, yes.
Remember, that the reason that happened was lenders were getting back then, emails and faxes and all kinds of inquiries for risky loans. Investors wanted these loans, just like you want loans that are pre-foreclosures or people who are upside down in their house or whatever. There were investors, not big lenders, investors who wanted those risky loans so they could charge high interest rates. And then, not care if they had to take the house back was the idea. Well, no, when things got tough in the economy and some of these really risky loans started going to foreclosure, then it was all crying in their beer. Oh, poor me. The lenders made bad loans.
The whole thing was a scam.
Yeah, they wanted the high rates. They wanted all that. But then, people tried to say that the lenders were making unsafe loans. So there are, we call them non-QM now. Subprime is a bad word, just like Section 8's a bad word. Now they call it the voucher program. So we don't call them subprime anymore. We call them non-qualified mortgages, non-QM, when you see that. And that just means something that doesn't fit Fannie, Freddie, FHA, or VA's guidelines. Okay. So those are the ones that are going out of business. But, that's the nature of the beast that happens.
It seems like we're coming back around to that business back in 08 as far as the economy. I'm just talking about the economy in general. I know back then it had to do with mainly the subprime mortgage, but with all the debts out there and we're seeing corrections going on, are you seeing in the lending market anyway, like let's say 6 months down the road or further before the year is out, that we're going to run into that liquidity crunch or freeze like what was almost threatened back in 08? Of course, the government stepped in and bailed it out, but this time they're not going to be able to do it because the debt's so high. So do you see that kind of scenario possibility in the next, that a crash at that level?
I'm not qualified to answer that. I never have studied, the secondary market or anything. I just have been an originator all my life. So that would be a good question for somebody else.
So, okay. So let's just, if something like that, even let's say we didn't go that far, but something like that happened, there was a liquidity slowdown, let's say. How would that, as far as investors going out, in terms of, because we're talking about exit strategies here.
Okay, sir, I sure appreciate it. Thank you.
Oh, yeah, we're talking about exit strategies here. So definitely the subject to and the owner financing would still work. I think your work, are you working with private funding in your business, or is it just the conventional lenders?
Just conventional lenders who are willing to be that special. When the realtors are all going on vacation and don't have enough to do right now. And so lenders too will go to a company that has these risky loans because they are the ones who are still willing to buy during high interest rates. The people who don't tell Uncle Sam they make much money. The people who can't prove their income any other way. So that's why the bank statement programs and such are so popular, because the money is really there. They're just not paying taxes on much of it. So there's a big push for the lenders in my business to go ahead and remember, hey, if you're not getting traditional applications, which I still am, it's just because I've been in the business so long, have a good following, but people who just got in the business all of a sudden don't have anything to do. But they're finding out that there are lots of realtors with buyers who would still buy, still have money because they're not paying taxes on their income, that they can close a deal with. So a lot of us know how to get, those risky loans for those people. And I don't feel like I'm doing anything wrong, of course, because I'm helping a buyer get into a house, but he is paying a little higher interest and he is paying a little bit more down. Just like the ITIN buyers, they're not legal here. We can't do traditional loans for them, but there are lenders who love those ITIN, individual taxpayer identification number loans for people who aren't here legally. So I think that sales are going to open back up now that sellers are not trying to take advantage of the lack of inventory. So I don't think it's going to go any further than that, but that's my prediction without the background to prove why I'm saying that. I just think that.
Okay.
Okay, folks. Well, listen, I'm going to sign off here. Hope everybody has a great week next week. Enjoy this nice summer heat. Looks like we got some more triple digits coming up. If anybody's got any houses that they are trying to sell or they want a JV on, reach out to me. Happy to work with you on them. And for those of you that may not be members today of the group, please consider it. It's a huge opportunity for you with the education and all the tools that we have and content available to you with forms and contracts and disclosures and all that kind of stuff. So hopefully you'll take that under consideration. Look out for announcement of the Lunch and Learn coming up. Of course, the mastermind meeting is for members only next Tuesday. That will stay a virtual meeting just because it's a weekday meeting and it's for the members only. But the Lunch and Learn, we're going to start doing those at different restaurants around Dallas-Fort Worth. I've got to pick the next one. And that'll go on the calendar when I do, but I'm going to be announcing another Real Flow event and then a Real Flow workshop. So keep an eye on the calendar for that. And
Tim, could I say something about the benefit of membership?
Sure, thank you.
It's just so amazing. It's like I was talking to Martin the other day. He was doing a conference call with me with a customer. This is a customer, a borrower who needs help that Robin found. And Robin looked it over and knew there was a problem. So then she referred him to me. And I literally had to go out and meet him to get all his documents because he didn't have a way to copy everything. He trusted me because of Robin to take all of his original documents and go to my office and copy them. And then because Robin and I both recommended Martin Garcia with Simplified Title, he ended up wanting to talk with Martin and see if Martin really thought he had a chance to close on his contract that he had. It ended up being one where he thought he had owner financing and he didn't. He had a contract to close in 2 months from now that was written 2 years ago, and a lot's changed since 2 years ago. So we have that ability to go within our group to our members and get the help to make a deal happen when it might not have ever happened in the beginning.
Yep. No, that's true. I mean, it's the power of our network, you know, and the relationships that we build amongst the members as well as amongst all the sponsors. And, you know, that's why, I mean, the sponsors we have been sponsors for a long time. We know each other. We know what we can do and not do. And that's why we need, you know, additional sponsors in the group that we can get to know and work with and, you know, trust when we need some. We know who to point somebody to. I refer people to Ruth Ann and Martin and Robin and others all the time. And, you know, we all benefit by having this strong network, and it's like a big family. So, and there's, in my opinion, there's no other group here that with as much value as what we provide our membership. I mean, it's peanuts for the investment, but the value of it with everything that you have available to you is huge. Now, it's all worthless if you don't use it, but it's all worthless. The best deal in the world is worthless if you don't use it. So, alrighty, anything else, anyone? Alrighty, well, I'm gonna let you go. Hope everybody has a great week, and we'll talk to you soon. Take care.
Thanks, Tim.